Good evening, everybody. I am Mark Sebastian. This is Principles of Risk Management, the Option Pit Method. Before we begin, let me start off with an understanding that this is for educational purposes only. None of this should be construed as investment advice. Consult your financial professional. Options have risk. Now let's start by talking about my favorite subject, which is me. My name is Mark Sebastian. That is me from, I don't know, maybe 2 years ago. I was a market maker on the floor of the CBOE and the American Stock Exchange, one in New York, one in Chicago. I traded options on hundreds of different stocks and on the S&P 500 and VIX and in the Dow Jones Industrial Average. So I've traded lots of things. Once I got done trading, I started Option Pit. Option Pit is an education and consulting company. On the consulting side, we work with money managers, hedge funds, large asset managers, fund of funds, and we help them develop strategies to implement options. We help test option strategies for risk or to find their weaknesses. And we optimize strategies to find the best way of doing each strategy. On the retail side, we work with individual retail customers to kind of show them the way professional option traders think. And that is a key. And we are happy to do that with customers. So I like to joke that I have clients that have $15 billion, and I have clients that have $1,500. And and we're happy to have both. We really enjoy it, and both bring a completely unique experience to working. On top of Option Pit, we run me and my partners, we run a hedge fund called Allocate Capital for accredited investors only. If you are accredited and you have interest, you can email me, but that's not what we're here for. So let's talk about what we are here for. We're going to talk about what is risk management. We're going to talk about money management, portfolio management, and position management. We're going to talk about looking for conditions and the option pit method to trading. So what is risk management? My definition for option traders is the taking of risk in the most capital efficient manner as such to receive the highest possible return for the fewest amount of dollars. So it's really understanding the risk-adjusted return of a trade. All right. What is the best, the most I can make on a trade given the amount of dollars I can make? All right. Given the amount of dollars I can put at risk. All right. Which sounds great, but how do you do that? And the key is trade structure, risk management, and efficient capital use. Our main pillars we have here. So, before flying a plane, pilots must go through extensive training as to how the plane actually works. You know, my wife's first cousin flies for American Airlines. And if you, I don't know, do we have any pilots here today? All right, well, I've got people telling me no. We may have a pilot here. All right, there's a yes. All right, so we've got a pilot here. And what this pilot will tell you is that before they even got behind the wheel of the plane, they went through extensive classroom work to understand how the plane works. Lift and drag, propulsion, all of the things that drive an airplane. These people know before they ever even get behind a simulator. So one might ask, well, why do they need to know that? That has nothing to do with what they're doing. All right. All they're doing is flying a plane. Who cares if they know how to work? Because by knowing how the plane works, pieces of the flying become intuitive. I pull up, right? I pull down. All right. I increase throttle. I decrease throttle. All right. I provide more lift, more drag. All right. And, you know, there's levels where if you don't know the theory, it can become a problem. There are major plane crashes caused by theory, by lack of knowledge of theory. And that's the same way with options. You need to be prepared for what can happen, and the only way to do that is to truly and intuitively understand options. So where to start? The start is understanding the instrument. All right, understand the instrument. How is an option different from an equity? How is one option position different from another? And that's key. Learn the workings of an instrument intuitively. And now what does that mean? Do you understand the basics? All right, a quote. Do you understand synthetics? Do you understand expiry? Do you understand how the pricing model works? All right, once you understand the basics and the pricing model, can you get the Greeks? And then from there, can you get to non-modeled Greeks? All right, you know what one of the major problems is with modeling? Modeling doesn't always work, so you have to understand how the model can break. Yeah, the inputs. Why does the model break? So why do you need to know this? Well, charts are nice. All right, there are all sorts of option platforms that like to give you pretty charts. Well, that doesn't mean they work. They're all built on modeling. So if you don't understand the model, you don't understand the chart you're looking at. You don't understand the chart you're looking at, you don't know the risk. So it is annoying. Eventually, once you understand options, you can learn shortcuts. You know, my wife played basketball for a very long time. And what she will tell you is that for up until she was about 16, 17, every coach was fundamentals, fundamentals, fundamentals. Right? Then, once you get so good at the fundamentals that you employ them intuitively, then you can start to get tricky with your shot. You can start learning things. All right? I went to a school called Villanova, which recently won the national title. Chris Jenkins, who hit a outside three to win the whole shebang, his mom would not let him take a shot outside the paint until he was past 12. All right, do we all know what the paint is in basketball? All right, this is the paint. All right. Never heard of the school. Thank you very much. So, why? Because she wanted him to learn the fundamentals. We have the same rule with our kid. He's going to absolutely be the best player since LeBron James when he gets in the NBA. But he knows that if he wants that to happen, he has to only shoot from inside the paint, learn his fundamentals. All right. So, but it's really and he gets frustrated, right? He wants to chuck threes, right? Just like everybody else, they want to do the fun stuff, not the fundamentals. Well, the problem is if you don't learn the fundamentals, you can't learn the fun stuff. So understanding how all this stuff works is the key to managing risk. And the funny part is, if you learn these fundamentals, the fun stuff actually comes faster. Spending the extra time to learn fundamentals will teach you how to make money faster than going and just trading right away. So this is a chart of changing risk. And what I want to show you is that these are 3 charts that all represent the exact same position. One represents a change in date, one represents a change in volatility, one represents a different change in volatility. One represents where it is today. They're all the same position, but they represent a total difference, in how the position reacts. Right? So things can change. So understand the contract you are trading. What are the dollars at risk? What is the multiplier? What does it expire into? When does it expire? You'd be shocked. I was asked to testify in a lawsuit where the person did not understand the expiration date of the contract and thought the broker should have told them. I said no, by the way. One would think that this is simple, but is it? Well, let's just look at some things. All right? Let's think about the S&P 500. How many different ways are there to trade the S&P 500? You could trade SPX options. You could trade SPY options. Trade options on the S&P 500 future. Trade options on the S&P 500 mini future. You could trade options on the S&P 500 mini cash. And that's just the start. All right, so now let's talk about money management. So once you really understand all your fundamentals, all right, and you're ready to trade, the next step is to build a money management plan. A money management plan will allow for how much of an account will be engaged in the market and how that money is allocated as it's engaged. So the question is, what kind of money do you have to work with? That's where you start. Can I realistically trade? What is your goal rate of return? What are you trying to make? Now this is where things get important. Can you allocate your capital so you're able to achieve that rate of return? Can that be done without a risk of blow up? So if you are gunning for a rate of return and you can't get it without the risk of losing 30% of your capital overnight, you have the wrong position or you're unrealistic on your trade. And then, is the plan efficient and does the plan scale? Capital. Different accounts warrant different approaches to trading, but do not treat any capital lightly. All capital is part of building success and wealth. There is no such thing as throwaway capital. You have no idea how many people I've met that are like, oh, it's only $6,000. Let's talk about things that you can buy for $6,000. You could buy this awesome drone. Look at that thing. You could buy a 1974 Dodge Dart Swinger. And actually, you'd still have $500 left in your pocket. Or you could get these awesome Christian Louboutin daffodil shoes for only $5,900. All right. These are all things you can buy with that money that you want to throw away. Thank you. Thank you, Mark. Here's what I'll say about the shoes. If I put those shoes out, if I put in one hand $4,000 and in my other hand put that pair of shoes and asked my wife, what would she rather have, the cash or the shoes? You know what she'd say? Oh, the shoes every day of the week and twice on Sunday. Why not both? Yeah, I just heard her in the corner. She's in the other room. She just went, yeah, that's what I'm saying. Why don't I get both? To be fair, she's pregnant with my second, so she can have both. Her push present's going to be, oh, thank you. Her push present is $4,000 and a pair of $6,000 Louboutins. What do you think? Except the only problem with these, it wouldn't be these. The only problem with these is that Lauren, my wife, is about an inch taller than me. So do you think I'm going to buy her 6-inch platforms? Probably not. But so the point is that once you and this is a mistake a lot of people make. They put their money in an account and it looks like funny money or casino dollars. Same thing people experience when they're at a casino and they're playing the machines. They don't realize how much money they're spending. A brokerage account can feel that way. Remember, that is real money. It is a lot of real money. So don't put money in an account just to throw it away. So now be aware of what is a realistic rate of return. Is 5% a month a realistic number? It sounds realistic, except for the fact that that equates to 80% a year. Is 2% a realistic number? That equates to 26% a year. That's doable. That's what my fund goes for. That's our target. 80% a year, that's what market makers go for. And they have incredible margin. You do not. Now, the reason why I bring this up is because I want you to be realistic. I do. All right. Most people are unrealistic with their returns. And so they try and overextend and they end up making silly mistakes. So now let's talk about allocating capital. How much of an account should stay in cash at any given time? And my answer is going to be 30 to 40%. So based on only using 60% of your account, what is your target return on traded capital to achieve your goal rate of return? Ceteris paribus, which means all other things equal, how should capital be allocated into each trade to achieve the target rate of return? How do you allocate your portfolio? If everything's good, how would you set things up? All right, and then allocate trading capital across trades. Pretty simple. Now, the risk of blow-up. When allocating capital, one common mistake is too much of a good thing. You need to be diversified. Be aware of the risks of your long-short premium strategy. All right. You have to be aware of your catastrophic loss. Rule number 1 of option pit. What do you think rule number 1 of option pit is? Something we tell all of our traders. Don't lose dollars. Close. No naked puts. True. Mike nailed it. Never go out of business. Always be able to trade the next day. All right, Mike, if you don't have a copy of my book, shoot me an email and I'll send you a copy. Marketoptionpit.com. You know, long story. It's mostly done, but we can talk about that later. All right, so never be short units. What are units? Those are super cheap puts. So or super cheap options. Once an option becomes worth less than 5 cents, always buy it back. Always be closing. Always be closing. All right. Remember, I want you guys to remember this. This is the key. This is so important. One more time. Think about this. And the point behind that is that I know so many people that tie up capital in positions that have 5 cents left in them. All right. I know people that have positions that have 5 cents left in them, and rather than close, they hold out for that extra nickel, which is the stupidest thing on the planet when you could have your capital to allocate into other trades. Always be closing. Always be closing. All right? If you're not closing, you are losing. So if an option gets cheap, cover it. Long options are different. Short options, if they're worth less than a dime, buy them back. All right, units are inexpensive. All right, they're cheap. All right, in the SPX, a unit's going to be worth less than $2. It's going to have a 2 delta. And the SPY is below 20 cents, and most name it 10 cents. Buy them back. Always be closing. Everybody say it with me. A, B, C. I want everyone to write always be closing. A, B, C. Always be closing. Always be closing. All right, now. I love it. All right, so Tom, shoot me an email. You get a book too. All right, now, once the money management plan is in place, make sure to evaluate the plan after its completion. Is there too much concentration on one short premium spread or another? What is the net vega? What is the volatility exposure of the position? Use the 1% theta rule for simplicity. All right? And that means, well, I'll tell you in a little bit. All right? And then, is there enough long realized vol exposure? Is there enough exposure to movement? Is there enough cash? Is there enough insurance? Do you need insurance? Is it scalable? If you can't trade a position on $200,000, you shouldn't trade it on 20. If you can't trade it on $2 million, you shouldn't trade it on 200. Good trades scale. Bad trades don't. If it doesn't scale, it doesn't work. Many retail traders take way too much risk. All right, now, the trading plan. This is the nitty-gritty of our capital allocation. It assumes all trades are in tradable but not spectacular conditions. It allocates capital each trade and then adjusts the size of the trades according to conditions. Put into place restrictions on losses and targets gains. And then it covers adjustment and strategies and insurance. Finally, adjust allocation to what trades are more or less favorable. Find the edge. Find the best trades and put more money in them. All right. If butterflies are statistically more favorable, you do them. If time spreads are, do more. If condors don't look good, don't trade them. Cash is okay. You know, have a plan that adjusts to the conditions of the market. If your plan doesn't adjust to conditions of the market, you have a crappy plan. All right, and then remember, cash is okay. So we had a really good question, and I want to answer this. I want to address this. So the guy said, I have a $10,000 account and I have 40% in cash. Then I should only have $6,000 in trades. At 2% a month, that's 120 bucks. Yikes, is that what our trading goal is? All right, well, let's go crazy and say that we're looking for 200 a month. All right, so that's 2% on the full 10,000. All right, then what you're really talking about is compounded about 25% a year. If you had a bank account or if you gave 10,000 bucks to a broker and the next year you had 12,500, you think you'd be happy? You consistently make 25% a month. Rule of 7, how much money do you have? Well, let's look here. And this won't take that long, but I just want to show you something. Why conservative works. There's your $10,000 account. There's 2%. And there's so here's a year. Let's see where things go. So let's just go out 5 years. So that's 60 months. Or we'll go out 6. That's 72 months. I can do all of these, can't I? Nope. That didn't go very well. So in 5 years, your $10,000 is 41,000 bucks. In 10 years, let's see what this is worth in 10 years. If you just stay consistent and you stay smart, what is this worth in 10 years? What do you think? Stop being so pie in the sky, people. That's my point. In 10 years, If all you do is try and make 10% a month, your account will have $170,000 in it. From a $10,000 account. Oh, you're right. That's 12. I'm sorry. You're right. In 10 years, you'll have $105,000. Sorry. Hey, what do you think I am, a math major just because I trade options? You have $105,000. You make 10x in 10 years. That sound terrible? So that would be, now, what do you mean statistically more favorable? There are trades that are better than other trades at any given time. Some trades stink given market conditions. Some trades are great given market conditions. This is where the term conditional trading comes from. Look at what is around you and trade it. Don't try and force it. Every time I see people lose money, it's because they force it. Now, keys to a trade plan. So what percent of profit should the commissions be? I mean, that 2% is kind of net of commissions. Your commission should not add to up more than kind of 30% of your gross. Now, write up the optimal conditions, the normal conditions, and no trade conditions for each trade. Write up an adjustment plan for any potential conceivable move. What do you do if the underlying rallies? And IV is down and falling? What do you do if the underlying rallies and IV is up and rising? Underlying falls and IV is up but falling. All these different scenarios you need to have a plan for on every type of trade. So what is a good condition? Well, take a look here. Here's the S&P in August. But take a look at what's going on beforehand. You could buy vol for less than where it was actually moving around. Then it blew up. Then you could sell vol as it sank. Conditions change. Understand what you're looking at. There are periods where it's time to weigh in on a lot of long vega. What about skew? This is curvature of an option. It can get really expensive. Buy it or sell it. So what you're doing is you want to set a maximum loss for each trade. All right, so what you're doing is looking at conditions and understanding what's going on. All right, when realized volatility is low and implied volatility is lower, own premium. When skew is high, sell skew, sell curvature. So now, set a maximum loss for each trade. This is the level the trade is pulled. Set an absolute max loss for each trade. This is a level that you'll never allow a trade to get near. It's your protection zone. For a condor, maximum loss might be the same as the target profit. Absolute max loss might be the credit. Now, why do you have two max losses? Well, the idea is that way you don't allow yourself to get stuck. All right, you don't allow yourself to get in a position where, you know, things can blow up on you. If you say, boy, I'm near my absolute max loss, you're going to make an adjustment or shut it down. It will save you a lot of money. Keys to adjusting. Now, this is important. For every trader, there's likely some variant of adjustment that is going to work well. However, there's some important keys to adjusting that will make sure you don't blow up. All right, I've seen more blow-ups from adjusting than actually the initial trades themselves, believe it or not. I've seen more people turn a $10,000 trade into a $40,000 trade and then lose their shirt than you'd be shocked. It's shocking. All right, so one, make sure you close those cheap shorts. All right, you're not a bottomless pit of money. Statistically, yes, they're winners, but you're not a bottomless pit of money. One of those blows you up. No, they over-adjusted. So let's talk about the third rule. When you are at a third of your max loss, you make an adjustment. When you're at 2/3, you make another adjustment. When you're at 3/3, you kill the trade. If you take this approach to cutting things and managing things, you'll be fine. Third. 3. Never throw capital at a trade. The idea that simply adding a butterfly or a calendar is simply wrong. Rolling increasing size works most of the time, but that's also where you blow up. So I'm going to give you a rule, and I want you guys to follow it, and it will make sure that you're able to trade forever. Probably. All right? Try to avoid adding capital to adjustments. Adjustments should reduce your margin, if at all possible. Never open up a cheap option and stay contract neutral or contract long. If you follow those 3 general rules, never open a cheap option, stay contract neutral or contract long, and don't add capital in an adjustment, you will not blow up. All right, assuming that you follow my 60% capital allocation rule. Now, if you've got like 200% margin on and you put this thing on, there's nothing I can do. But if you only use 6% of your available capital, and then you follow the other 3 adjusting rules, you'll be fine. If somebody comes in and tells you, oh, just add a butterfly, add more capital to trade, they're setting you up to fail. It's easy. It's a really easy adjustment method to teach. I teach you a butterfly. I teach you to add another butterfly. Wonderful. I teach you how to blow up. I teach you how to blow up more. That's basically what they're saying. Because it's intellectually lazy. You know how many intellectually lazy rich people there are? Other than the children of dead people, not many. That's exactly right. Market always wants you to adjust by getting bigger. Proper adjustment always is getting smaller. That's good, Mike. And I think that's a character from Back to the Future, isn't it? Back to the Future, isn't it? Now, let's talk about how we do things at Option Pit. As a trader becomes, and this comes from our approach to market making. When I was a market maker, as a trader becomes more or less short premium, you're willing to accept less trade to less edge, less theoretical value to take the opposite side. So if I sell an option, I'm willing to spend less, or I'm willing to accept less value to buy an option. You know? So think about it this way. If I buy my wife a really nice purse, then she's willing to deal with a mediocre wallet. All right. So if I'm long a lot of premium, I want to find something to sell. If I'm short a lot of premium, I want to find something to buy. And the key is offsetting Greeks. Now, the beauty of this trade, the beauty of the market maker approach, is that if I am generally, from a portfolio perspective, pretty contract neutral, but I have edge in what I buy and sell, I can make money on what I buy, and I can make money on what I sell. But what happens if the world goes to hell in a handbasket and I'm net flat contracts or net long contracts? I'll probably make money or at least not lose a lot. So, and we'll talk about the option pit method here in a second. You don't have a bottomless pit of capital. You don't have trades coming to you, but you do have an edge. You can initiate every trade. If you're not using your edge in the ability to initiate, you're not trading right. Every trade should have a perceived edge to it. These options are too expensive. These options are too cheap. Each successive trade. So I think these options are too expensive. So I do a butterfly. Your next butterfly better be better than the previous one. So if you're adding Greek risk, it's got to be a better and better and better trade. All right, you ladder higher. Your first trade is somewhat small. Then you get bigger and bigger and bigger until you kind of reach your full size. And at some point you cap out. As you build, you're then actively looking for the other side. So, if I have a butterfly on and a condor and all these trades, I'm then actively looking to buy straddles that I think are cheap. So the point gets that it's at a certain point, your position gets so one-sided or the other, it becomes very difficult to sell and very easy to buy until that equilibrium rights itself. I'm long a lot of delta. I'm going to look for something to go short. I'm short a lot of delta. I'm going to look for something to go long. All right, I'm short a lot of Vega. I'm willing to look for trades that have edge that will get me long Vega. So if executed properly, and this is what we do in our strategy ladder, the trader should be able to carry a net portfolio that has little systemic risk. The portfolio will have low net Greeks, and each position will have Greeks though. So the idea is that at the portfolio level, it looks like you don't have anything. But then each position has Greeks that have edge in them. If I can limit risk to company risk and away from systemic risk, I'm going to do fine. I'm going to do great. The only thing that, I can make money as long as August doesn't blow me out. Now, things to remember. You need to learn how to capture edge. You need to learn how to weight your Greeks. You need to understand Greeks as part of capital and Greeks as part of beta. You understand, now, fight for low commissions. That's something I do for my clients. Get your commissions as low as possible and then stop worrying about them. And then it requires a little bit more active management, but it's still part-time. All right, now obviously we have lots of clients that do this as a job, but it doesn't have to be. This can be a part-time thing. And this is the most important. And this is the key. Requires strong understanding of option fundamentals. And actually making money requires strong fundamentals of options. Now, the most important things to understand from that perspective are gamma and vega. Understand your gamma, understand your vega. If you understand your gamma and your vega, the rest will take care of itself. Be aware of how the Greeks change with underlying prices. A balanced portfolio can change on you, and understand how your portfolio changes with risk metrics. As Vega changes, as vol changes, as price changes. So understand the portfolio. So in the end, our method will have you put on good trades, manage the portfolio, manage each trade on its own, but manage the portfolio of Greeks, and of course, you always got to remember, remember that, folks. So, the benefit, you'll sleep well at night. You won't have anything to worry about. All right? Risk will be lower. Your trade duration will be slower. You will probably be profitable, and you can be wrong a lot. Here's a little sample portfolio. 40,000 bucks. 20,000 in short premium trades, butterflies, condors, counters. Now, what do you notice about these three trades? What's special about them? Their net contract what? Contract what? They're contract neutral. Right. All right, now you spend $5,000 in straddles and back spreads. What is the value of owning a straddle? Is that contract neutral? No, it's not. So imagine this. I've got this short premium making me money. I bought these cheap straddles that are net contract long, spent a couple thousand trading VIX, VXX, and UVXY. I pick a couple of directional plays, and I've got 12,000 in cash. There's the portfolio. Trades generally should be about the same size. A trade should not account for more than 5% of total capital. Thus, our $40,000 portfolio should tie up about $1,000 to $2,000 of margin of trade. An absolute home run trade can't lose. Should never be more than 10% of your capital. 4,000 bucks on a $40,000 portfolio. Never more. Like the Raven. So now ramping up. The first trade in a portfolio should lean small, not big. If one has a butterfly on, remember the next butterfly needs to be better. And if one has done an offsetting trade, that's when you increase size. You increase size. You can go bigger when you find an offsetting trade. I sold a butterfly. Oh, well, look at this cheap straddle I just bought. Now I can do a bigger butterfly. So the key is understand options and risk. Learn to have a money trading and trade plan. Understand how offsetting positions work and allocate your dollars efficiently. Now, this Saturday, that date is wrong. Fix that. May 7th at 9:30 a.m. Eastern Time. Long-term option positions and hedging. We're going to teach you about hedging with VIX, hedging with S&P 500, hedging individual positions. We're going to teach you how to completely replace your stock portfolio. We're going to teach you how to extract dollars from your long-term portfolio. We're going to teach you to hedge and dynamically protect assets. And I'm going to teach you some risk management things that I didn't cover here. We're going to put this up for 300 bucks on the site, and we're going to sell a bunch of them. Tonight, 167 bucks, but use code 25_off, OFF, and that's all capitals. And you can take 25 bucks off if you sign up. Today's Wednesday, so let's say Friday. Sign up by Friday. I apologize, I forgot to fix that. Two little things. Go to optionpit.com/long-term to sign up. That's also, so tomorrow I'm going to send out an email with the replay. The replay is going to be in the middle of the page where you can buy this. So the replay is going to be on optionpit.com/long-term as well. This is going to be an awesome course. All right, now, your other option is register and subscribe to Option Pit Live. All right, why? Well, if you are an Option Pit Live subscriber for $125 a month, guess what? You get all of these for free. Just email me, John, and I'll send you the slides. I don't care. All right, this is going to be a spectacular course, and the deal ends Friday. And then we will sell this to a lot of people at $300. Or they'll be smart and they'll get a subscription to Option Pit Live, which is only $125. And you get the strategy letter and access to our chat room and access to our professional traders and email support and access to our strategy letter. And if you keep your subscription active, all of our Saturday courses are free. Pretty good deal. But if you just want to try things out, you want to see what we're like, optionpit.com/long-term. $142 once you use your coupon. Still a great deal. Less than half of what the thing's going to end up costing when we put it in the store. And those people will be buying a recording. Well, thank you. For sure. Yeah, just shoot me an email. If you want the slides, shoot me an email. This is one of my favorite presentations because it makes people think. And I mean, most of the stuff that I do involves like digging into a butterfly or something like that. But this is my main what did you guys think? Think about what makes sense. And that's the real value of this one. But this course is going to be awesome. Andrew and I have been talking about how we're going to structure it. It's going to be pretty sick. So it will absolutely pay for itself. And you get the recordings if you can't make it. So optionpit.com/long-term. All right, folks. Any other questions? All right. So if you're going to take the class, I want you to sign up now, because that will make me feel happy about all these people are going to be learning from me on Saturday. All right. Have a good night, guys.